The euro continues to correct lower against other major currencies after the IMF warned that the eurozone is exposed to a downward spiral of capital flight, breakup fears and economic decline. In the Global Financial Stability Report, the IMF said that risks to financial stability have increased since April as confidence in the global financial system has become very fragile. And intensification of the crisis has manifested itself in capital outflows from the periphery to the core, at a pace typically associated with currency crises or sudden stops. The IMF predicted that European banks might need to offload as much as $4.5 trillion in assets over the next 2 years to lower their exposures. That's 18% higher than the estimate given back in April. Yesterday, the IMF lowered estimates of global GDP to 3.3% for this year and 3.6% for 2013. In the ECOFIN meeting held Tuesday, it was decided that Portugal would be given an extra year to meet its deficit target, and a recommendation sets deficit targets of 5% of GDP for 2012, 4.5% of GDP for 2013 and 2.5% of GDP for 2014. Regarding the banking union, Dutch Finance Minister Jan Kees de Jager stated that it is difficult for the EU to create a single mechanism for banking supervision by the deadline of January 1st. Disappointedly, there's no progress on Spain's request for bailout. Technically, Euro-US dollar is set to dip to 1.28 and below to extend recent consolidation. Euro-yen will also take out the 100 psychological level to 99.63 support. Euro-sterling looks top below recent resistance of 0.8114 and it is possibly heading back to 0.8 and below. Euro-Aussie is still heading back to the 1.2328 to 0.2552 support zone. So overall, the euro will likely be soft in near term. Though, the larger outlook is still bullish in the common currency and thus, we'd expect the current weakness in the euro to be relatively limited. Fed Vice Chairman Yellen pledged that it will unwind the asset purchases in a timely manner at appropriate time to avoid inflationary pressures. She also emphasized that stronger U.S. growth is beneficial for the entire global economy. Yellen also said it's not the Fed's intention to make capital flows more difficult and the emerging nations will have tools to manage that. The Bank of England Governor Mervyn King said that total output in the UK is now some 15% below an extrapolation of its pre-crisis trend, and he warned that the gap is likely to persist for some time. King said that there is no technical limit on asset purchases, but there are limits to what monetary policy as such can do. He also said that the current difficulties in solving the European crisis bore a comparison with the disputes in the 1920s over German war reparations that was too poignant to dwell on. On the data front, Australian Westpac consumer confidence rose 1% in October. Japan machine tool orders dropped 3% year-on-year in September. The US will release wholesale inventories and the Fed's beige book later today.